Welcome back to our financial market update. Let's start with the numbers. Bitcoin is trading at $77,451, up 0.82%. Ethereum at $2,130, up 0.79%. Looking at US equities, the QQQ is at 701.53, the SPY at 733.73, Nvidia at 220.61, and Tesla at 404.11. In China, the Shanghai Composite closed at 4,162.18, down 0.18%, while the Chinext Index rose 0.34% to 3,921.79. The 10-year Treasury yield dropped to 4.65%, the VIX is at 17.98. Brent crude fell to $108.52, down 1.87%, and WTI crude dropped 1.83% to $101.81. Gold hit a new high at $4,500, up 0.47%. The dollar index is flat at 99.38. The key takeaway today is clear divergence. U.S. tech heavyweights and the Shanghai Composite are showing structural divergence. Gold is hitting new highs while crude is plunging. Capital is shifting between risk assets and safe havens without a clear direction. We assess the market will be range-bound with a slight bearish bias, with about 60% probability. The decline in the 10-year yield and the VIX would normally be positive, but these are offset by gold's rally and a flat dollar. This contradiction is intensifying the consolidation. The main capital flow is moving away from inflation trades and into safe haven trades, with money leaving commodities and flowing into bonds and gold. During the Asian session, the Shanghai Composite was range-bound, but the Chinext Index rose, indicating some local activity from domestic investors. European session data is missing, but based on futures signals we expect caution to continue. In the U.S. pre-market, lower Treasury yields and a lower VIX are usually positive for risk assets, but high gold prices and a flat dollar create a counterbalance. We assess the path blocking probability at 55%. On the macro front, the interest rate headwind is weakening. The 10-year yield at 4.65%, while still high, is easing pressure. The dollar index is flat with no clear direction. Inflation pressure is also easing as Brent crude falls, reducing imported inflation risk. However, gold at $4,500 suggests the market still worries about structural inflation or tail risks. Geopolitical risks continue to support safe haven demand. For core assets, U.S. equities are range-bound with a slight bearish bias. Lower Treasury yields support tech valuations, but Nvidia hasn't broken through $225, and Tesla is at a key level. Chinese equities are driven by domestic investors with a shift toward small and mid-cap stocks. Bitcoin is up slightly but hasn't broken $78,000, showing internal divergence in crypto. Crude is plunging as money exits commodities, and gold's safe haven premium is rising. The capital flow theme is very clear. Safe haven money is flowing into gold and U.S. Treasuries. This direction should be sustainable at least through next week. For crude, we see either short covering or further decline with intraday weakness. Two key battlegrounds to watch: first, whether Nvidia can break $225, which would determine if tech stocks can rally further. Second, the $100 level for WTI crude. A break below could trigger program selling. For today's trading strategy, we prefer a controlled long position in tech and growth stocks, but with caution. Entry conditions require the SPY to hold above 733 and the QQQ above 702. If the 10-year yield breaks below 4.6% and Nvidia breaks 225, we can add to positions. But if the VIX rises above 18.5, we need to reduce exposure. If the SPY falls below 730 or Bitcoin drops below 76,500, we must stop out immediately. Here are our verifiable predictions. U.S. equities will trade in a narrow range before the open, with the QQQ closing between 698 and 705. The Shanghai Composite will continue to trade in a tight range between 4,150 and 4,175. Bitcoin will trade in a narrow band between $76,800 and $78,000 without breaking higher. WTI crude will test the $100 level. Sector divergence will intensify today, with gold mining stocks and tech outperforming while energy stocks lead the decline. To summarize our probability assessment for today, 25% chance of an up day, 50% chance of a range-bound day, and 25% chance of a down day. Investors should remain vigilant, keep position sizes manageable, and stay flexible in their approach.